我不知道多少人同意这种说法哈，就是说在金字塔顶层这0.1%的人，跟下边这99.9%的人了解到的信息和思维方式差别一定是很大的。不管你是在华尔街工作还是在硅谷工作，只要说你站的这个位置不是在上层建筑的话，其实就很难知道这个市场里面的交易到底为什么是这样布局的。这一期呢，我就请到了金字塔顶端0.1%的人，他拥有非常丰富的实战经验，也是从业36年的家族办公室的管理人 Eric Stanley。那家族办公室呢，有些朋友可能知道哈，就它是投资行业里面挺神秘的这么一种机构，非常的低调。很多人知道这种机构的存在，但是实际上去在里面工作或者见过它的，其实并不是那么多。不过在我的软磨硬泡之下，我还是把他拉来录这么期节目，让他来跟大家讲一下，到底他是怎么评估和挑选项目的。标准又是什么？那现在的这个市场和20-30年之前的市场到底有什么样的区别？它又是怎么样帮助一家公司在1年之内从营业额为0增长到了2亿5千万美元？在第18个月创始人撤出的时候，创始人拿到了将近10个亿美元。这一期的文字版总结呢，就放在我这个描述栏的链接里面，大家可以点进去看。另外，我强烈建议大家完整的把后面这1小时的访谈看完，因为我可以非常非常负责任的告诉大家，在私下我每一次跟 Eric 相处都能够学到很多东西。那这一期的内容呢，也是我自己在中文内容里面几乎是找不到的。当然哈，你选择不看也没有关系，反正你也不会知道你错过了什么。毕竟我能做的也只是说给大家提供一个选择和优质信息的渠道。那如果你选择把这一期看完的话，我相信你一定能在这一期影片里面找到之前从来没有接触过的信息和思维方式。So if you choose to stay, enjoy this episode.
I still call it Twitter. Is that weird?
I still call it Twitter too. How to build the networks to acquire all kinds of deals and do all the funding businesses.
Yeah. So relationships are really important. So when I first got it started in building a network, I didn't know what I was doing. Now we get all of our business through relationships, through networking, and it's very important to us. So back in the day, I had about 20 connections. One of them was my mom. That would be the only person that you'd want to know. Everybody else you wouldn't care about. And nobody would want to connect me.
And you two started a business together, you and your mom, kind
She
of.
started it. I was employee number one. I just graduated from high school, so that tells you a little how old I am. But I went off in the military, went off to Hawaii, went off to Japan, came back and didn't have any connections, and I was introverted. I still am, I guess, but I've learned to deal with that. But I didn't really want to go out and try something I hadn't done before. So I read a book called Never Eat Alone by Keith Ferrazzi. I really highly recommend it. It's an older book. He's redoing it, making a new edition of it. But it taught me what I needed to know, and so I started applying that on a really old website that was going to go away called LinkedIn. And everybody told me don't waste your time on LinkedIn. It's it's not worth it. And this is back in 2004. So we started the business in 1989. So I have a big hole there where I was away for a while. And then 2004, I was a programmer in our EDI division, which we later sold off. But I was learning how to become a networker and a salesperson. And so I started applying Never Alone by Keith Rossi on LinkedIn because it was safer. And so I started meeting people on LinkedIn. And if the conversation went somewhere, then we would, if they were close by, we would get together and have coffee and chat and build local relationships. Because no matter what, you gotta end up building the relationship, right? And then when LinkedIn came out with groups, it was just a list of names. There was no functionality. So we started a group called LinkedIn Houston, and then we started a Yahoo group for that group so that we could chat because there was no functionality on LinkedIn. And from that, it grew, and I eventually got a call when it was about 2,000 members. I got a call from the lawyer, of LinkedIn. And so he said, terms and conditions, you can't call it LinkedIn anything. So, you need to change it. And I said, well, great. That's awesome. By the way, this is something you should take a note for right here. But I said, do you have my address? And he said, no, I don't have your address. And I said, that's great.
Great.
So free legal advice. And he laughed. I said, what should I call it? And he laughed again. He said, well, I can't tell you that, but throw something at me.
Yeah.
So three important things there. Don't ever take legal advice from somebody who can send you an invoice for it.
Right.
That's why I asked about the address. And then, it's important to get them to laugh a little bit. It breaks down the barrier, right? So if he was angry with me or upset with me, he probably wouldn't have offered advice. Anyway, so I said, well, what about in Houston instead of LinkedIn? Just take the in from LinkedIn and put it in front of Houston. Does that work? He goes, yeah, that works. So we changed the name. And eventually we got to the point where we were doing in-person networking events, for really just for meet and greets. And it was every second Wednesday, and it started out in a place called the Tasting Room, and it was this little closet of a wine bar in Uptown. And just as we started using them, they had expanded out to the corner. So they rented out more space and built it out. And we came in and said, hey, can we bring our group here? At the time, I think maybe we were 100 people. Every second Wednesday, people would show up for servant leadership networking, or give first networking is what we call it. And I wasn't making any money doing it. I was just spending that Wednesday from about 2 in the afternoon until everybody went home, just being there to network with people and teaching people how to do the give first networking, which was, the idea was ask people what they need. Don't try to vomit all over them about what you need, right? And then help them get what they need, right? And so I built organization doing that. I built my network on LinkedIn. We grew the networking organization to 30,000, 150,000 members, and
Are they all in Houston or
no, some
all over
of
the place?
we're all over the place by the time we got to 150,000. But initially, 30,000 was all Houston because we just didn't have any reach outside of Houston.
Oh, even without any reach out, it's still 30,000.
Yeah,
That
yeah.
sounds like a hotel.
When I got to 15,000, the Greater Houston Partnership, which is a big chamber in the Houston area, called me and said, are you trying to start a chamber? And I was like, no. I started this because I wasn't getting what I wanted at the chamber. We're just a networking group. We're just for, meet and greet and kind of sharing business cards and helping each other out. And but anyway, so eventually we got to a point where we were 450 plus people showing up at this wine bar, and it was in the middle of the summer. And I remember their air conditioner broke because there were so many people in the wine bar. It was standing room only. It was just wild, crazy, and there's people coming and going all over the place, and a ton of business was getting done. And so I would just, introduce myself to somebody, find out what they do, and find out how I can help them. And then I knew people in the room, so I'd drag them around the room and introduce them right there. And they'd meet somebody that either could help them with a problem that they were having, or that they might be, customers of each
But
other.
this is a good thing about not having a very good social media network. That's
Oh,
before that time.
yeah.
All right. Otherwise, it's really difficult for people to actually show up.
Actually, about that time is when I got invited to go to a private meeting at a River Oaks house. A really rich guy, I can't remember the guy's name, was doing a investor meeting for a company that was coming out of the East Coast. It was a company that eventually became what's called Facebook. This was before they IPO'd, and they were selling off their employee stock. And this is what a lot of people don't know about those kind of investments. As it gets closer and closer to IPO, some of the employees will sell off their stock so they can have more money to do stuff. And I didn't invest, so
oh no.
well, at the time, to be fair, it was a dating site.
It was actually a dating site for college. That's
I couldn't even get on it. I tried. I tried to get on there. Like, you need a college email address. I'm like, I'm done.
Like, you're not in college and you're not in a dating pool, so
Yeah, I just wanted to see what it was like, and I couldn't even get on it. So I wasn't impressed, to be honest. Good job, Zuckerberg. You got it past where I could see it.
Now it's better than dating, but still, I mean, back in those times.
Yeah. I mean, yeah, as they grew, the functionality became more business friendly.
Right.
And then, the kids left Facebook and went to something else, and so the old folks got on Facebook trying to find their kids.
You do business buying, but you don't do real estate. I'm closer to real estate, even though like I steal a lot of knowledge from you about business buying. Haha. It's okay. I just bring dumplings and I get all the knowledge. Very cheap way to get knowledge. Anyway, so why do you pick businesses instead of real estate? Because real estate seems to be a very easy way to, well, it's easy to calculate, at least from my perspective.
Yeah, I mean, there's a lot of landmines in real estate from my perspective, but we're actually first a funding company. So we actually sold off one of our funding divisions to a bank recently, but we've been funding in the last actually 36 years. We funded tens of thousands of companies and tens of billions of dollars. We didn't start out to do that. We looked up after 30 years and went, wow, look what we did, and at the time it was thousands of companies and billions of dollars. But divide by 30, divide by 36, you can kind of get an idea what we've done. So, but it was funding for B2B companies. It wasn't everything. We didn't do direct to consumer. We didn't do, VC, equity, angel, private equity, any of that stuff. We were focused on in revenue companies, so it was a good focus for us. We started out funding machine shops, a lot of which were in the oil field. Banks can't get their head around machine shops. It's too hard to understand for a banker. And oil field, they don't like oil field at all. So it was a great place for us to be. And then we grew into just about every B2B industry or subsector that you can imagine. So, we do oil field, IT, staffing, manufacturing. And in manufacturing, we include things like tree farms. We include like distilleries, like whiskey and bourbon and vodka and stuff like that. We include plastics like 3D printing, extrusion, vacuum molding, injection molding, blow molding. There's a bunch of different ways to mold plastic, and they get used in all kinds of industries. So those are all manufacturing, but they're manufacturing for, like automobile or aerospace or space or even in the oil field, they'll take stuff and put it back in the oil field like that. And so all of those things become manufacturing for us. And then we focus on what we call B2B, but we include B2G in there. So for us, any entity that's doing business with another entity is B2B.
Yeah.
And so for us, B2G is great as long as it's not like a local. Yeah, government, yeah. As long as it's not a local, small town kind of government, we can typically get our heads around it. But we like, of course, the big federal government type stuff, big state government type stuff. All of that's B2B in our opinion. So we can get our head around how to get in that, and then how the customers get paid and stuff like that, which is really important. If they're not getting paid, how are we getting paid, right? So, but yeah, so was starting with funding, we got good at funding, and then we realized along the way our customers taught us about acquisitions. And so we learned from a staffing company manager how he could use us to buy the staffing company from the owner, who was 75 and looking to retire at the time. This was before 2001. I know it was a long time ago, right? And then we had a oil field chemical company in Oklahoma where there were 4 partners. They hadn't set up any way to pull a partner out when they died, and so when a partner passed, they had to figure out a way to pay the partner's estate out, because it had to be cleared out of the partnership. And so we were a solution for that. So in a way that's involving, mergers and acquisitions. It's so the only thing we'll do in the partial kind of buyout space. That's something we've got our head around. And we also started learning, not that we look for this at all, but we started learning about bankruptcy and debtor in possession and stuff like that. So we've learned how to play in that field as well. So having said all that, then prior to 2008, I started looking at buying companies. And when 2008 happened, I was sitting in my mom's living room watching TV because nobody was doing any appointments. Nobody was meeting for coffee and talking because the stock market was crashing and the sky was falling, right?
Right.
So I was bored out of my gourd. In fact, it was a work day and my mom was home. I don't know how that happened because she's never home like that. But for some reason, she was home. I was watching TV, and this guy on Fox Business, it was 205, Fox Business Channel, and it was a lady who said, and I wasn't
205 is the cable
the cable channel,
channel.
yeah,
Oh my gosh,
yeah.
is
So
that why
yeah,
this sounds so old all
yeah,
of a
yeah.
sudden?
Sorry, I'm old.
No,
So
2008 is not old. Just cable. The concept of cable is getting really old
yeah,
now.
yeah, yeah, yeah. So, but I was just flipping through the channels, and I just happened to stop. I don't watch Fox Business because it's typically public market stuff.
Right.
It's never anything I want to talk about or listen to. But she said while I was on the channel, she said valuations of privately held companies are going from 5 times revenue down to 2 and 1.5 and 1 times multipliers of revenue as their asking price. And I was like, holy cow, somebody else is getting what I'm getting, right? And right about the same time, Robert Kiyosaki had started talking about the what we now call the silver tsunami. He was writing
Yeah.
the book that became, I believe it's Unfair Advantage, but it
Okay.
wasn't called that. He was publishing it one chapter at a time on Facebook.
Oh,
He's
okay.
the only person I ever know who did that. I was following it because I followed Rich Dad Poor Dad and all that, but I knew about this before he started publishing it, and then he started publishing his stuff about it, and I realized I wasn't the only one thinking about this. Of course, I knew I wasn't, but I hadn't met anybody who was talking about it, and he was talking about a professor in the Midwest who was saying what was going to happen next in America, and he was saying that you know there were going to be more companies for sale than there had ever been before in the history of America. Baby boomers were going to start hitting 65 or retirement age at 10,000 and 20,000 and 30,000 and 40,000, just huge numbers a day. People were going to be hitting retirement age. And that generation was, can I say, brainwashed into believing that they had to retire at 65. Even though they were business owners, they were ready to go play golf and live in a community in Boca Raton, Florida. That's the kind of thinking they had, right?
What really should happen is like entrepreneurs don't retire
Yeah,
until
I
the last
don't
day of their
understand.
life,
I
kind
really
of
don't
thing.
understand thinking, but I got tired of trying to convince them to stay in business. So I was like, okay,
Right.
I'll take your business.
Well, it's a good thing for you. It's a good thing for you.
I decided I'd go ahead and make it an advantage, right? So,
Right.
but anyway, so 2008 happens. We think we're going to lose banking. It's going to go away. That's what
System, you
everybody
mean?
was. The
Yeah.
whole system was going to go away. Everyone was like, "What in the world is going on?" Banks were shutting down at hundreds a month. It
Right.
was just crazy, and then they were propping up the big ones who were the biggest problem in the whole deal, right? So we were like, "This is not going anywhere," right? And then prior to 2011, I already knew that I was looking at the date in November of 2011. That's when baby boomers were going to start hitting 65 at 10,000 plus people a day. But then 2008 happened, and that just changed everything. It brought everything forward. All of a sudden, baby boomers were selling their assets and firing their employees and shutting down their businesses in huge numbers. And it got really big. November 2011 is when they started hitting at huge numbers. And by May, 6 months later, May 2012, we had the largest uptick in unemployment we'd ever had in the history of America to that point. And it was because baby boomers were selling their assets and firing their employees. And so it was really happening. It was hitting. And the problem is there's this huge supply of companies for sale and a really low accurate demand. Like there was a demand, there was a bunch of people who wanted to buy companies. They just didn't have any money. And back then the SBA didn't have any programs to help them. And it was hard to get money. So there was a bunch of people who were pretending to be buyers, and they were going out, and auctions on companies were happening, and people were trying to buy these companies. They'd lock it up and then they'd do like a real estate deal. They'd
Right.
lock it up and then go try to find the finance. And it wasn't happening. Sellers were just going through round after round after round of failed sales.
Because the banking wasn't working, of course, no, they can't get any kind of money to.
Their balance sheets were upside down. They were
Right.
going through stress tests.
They're
And
not
there's no
going to
way
be
a
able to
bank's
lend.
gonna,
Yeah.
and then everybody who had free cash lost it in the crisis and in the downfall in the market, right? So all the free cash was gone.
Yeah.
So the people who could do it, was a very small number of people who could do it. Like we were in a place where we could do it, right? And
Why were you at the place that you could do it? You saw something coming, or?
well, yeah, we saw 2008 coming a year before, because everything we look at is leading indicators. Well, almost everything. There's some things we look at that are trailing indicators, but a lot of the stuff that we look at in business is a leading indicator. It tells us what's coming, not what's happened, right? So most banks, when they're looking at deals, they're looking at the past. Like they're looking at the last 2 years. They don't want to see the future. We want to see the now. So we're not looking as much in the future, but we're open to seeing what's the future, because we want to know from now where we go. Are we going up or down, right? And so we saw banks, because we call on banks to get deals and stuff like that, and we saw banks standing up REO divisions, so real estate owned, which is essentially the bank has assets on their balance sheet because they're foreclosing on loans, and those people who had those loans can't pay, so they're returning that collateral to the bank, and the bank and the bank calls it REO, and so they had to stand up huge divisions just to deal with it. Like they'd hire 30, 50 people to work in offices just to handle REO, and so we saw a lot of that ahead of time. That was happening in 2007. I think it might have actually started in 2006, but we started seeing it in 2007. So we kind of had a feeling something was going to happen.
Otherwise, they wouldn't need that many people in that department.
Why
There's no
hire?
point.
Yeah, there's no point. But the minute 2008 happened, the Lehman crisis happened, boom! All of a sudden, people were filing, for bankruptcy, and they were defaulting on their loans and stuff like that. So we saw it coming, and we saw this baby boomer, wave coming. And so for us, acquisitions just made sense. Why not, right? So I was in my mom's living room watching that TV show, and I leaned over and said, "Hey, any reason why I can't buy companies?" And she didn't say a thing. I thought she didn't hear me. So
Oh,
I was just ignoring her, listening on, and all of a sudden, like 15 minutes later, I hear from the kitchen, "Hey, no reason. Why not? I guess. Why don't you go ahead and do that?"
oh, she was just thinking.
I had no idea she was even thinking. So, sure, why not? And I was like, okay. So then that's when I really started thinking about it. Because at that time, I was actually trying to coach business owners how to use our funding to buy companies. And it was just getting hard to do it. Business owners were already like, the sky's falling, chicken little all over the place, right? And they didn't want to buy anything. They didn't know what was good.
Yeah.
But see, we were in a place where we had the finance we need. We had the funds we need. We were funding, hundreds of millions of dollars a year, and so we knew what we could do, and we were prepared for the trouble. We never had any trouble after 2008, except that business, just slowed down. Well, it wasn't our fault, but everything else we were fine, right? So, we I forget what we were talking about actually.
How did you start the acquisition?
Yeah, acquisitions. Yeah. So yeah, I mean, it was really a combination of all those things, and I mean, it's been up and down. We've had years where we looked at thousands and thousands and thousands of deals and never bought a thing.
Like 2023.
Well, 2023, but even before that, Corona was horrible. And then the country stepped in and started doing PPP and ERP
Right.
and all these other things, and or ERC, I think it was, and just all these they were funding America, which is
Right.
stepping on my toes. Like, I don't need you there. Can you go
Right.
away, please?
How am I gonna do my business if you keep funding them?
And your money is way cheaper than my
Right,
money.
right. Even though your money is actually pretty cheap, I have to say.
But at that time, it was,
Yeah, yeah, right.
we were about the same. Later on, when interest rates started going up, then bankers were coming to me going, "Eric, you should go loan money to the Fed. They're more expensive. You could probably make a
I
a
know.
delta on that."
You can make no, I'm not gonna say the number, but like I know the number,
Mhm.
kind of. It's pretty cheap.
I think it is. I think, when you consider equity versus what we do, because we're a fee for our money, you use us, you pay the fee. You don't use us, you don't pay the fee. You can go months without using us as a funding vehicle and not pay a dime. There's no cost, right? You go months after taking a loan, you're still paying that loan payment. There's a cost on a regular basis, right? And so, for a business to take on equity, I mean, even in real estate, I'm sure, but in the business world, in private equity, if you take on private equity, you have to promise your limited partners in that deal that they're gonna get a 4x return on their equity plus X% on the money while it's out, right? So, it's way more expensive to do equity than it is to do what we do, right? And I'll give you an example. We had a guy who he built billion-dollar divisions in 4 different companies. He had, been laid off for the 4th time. He was in the oil field, and he started his own business at 59 years old, first time ever. So a bank didn't lend him any money. VCs were going to give him 25 million, and that didn't work out because they wanted too much of his business. He didn't want to give it up, and so he came to us month one. He needed $100,000, and so when he used us for $100,000 month one, we were like, okay, where's this going to go? Month 1 through 12, he averaged using us for over $10 million. Where else could he have done that, right?
Yeah.
The most he was gonna get from venture capital was 25 million. Well, if you look at the numbers I just gave you, he would have run out of that money in month 3 or 4, right?
It's hard to scale if that's from
You're
the
stuck.
venture, right?
You're
Yeah.
stuck. At that point, they're not gonna give you any more.
Right.
It dilutes their position.
Right.
Why would they? Right? But we were there for that guy. In the first year, we were there for 150 million plus. In that first year, he went from 0 to 250 million plus in revenue.
Mm.
And at the end of 18 months from starting his company, he sold his company at almost $1 billion.
It's all because of this enough money for him to scale.
Yeah.
Otherwise, if it's from other VC or even just from the bank, it's gonna be very hard.
Right. What bank is gonna reevaluate a loan
Right.
6 months into a loan or 3
Right.
months into a loan? But we were increasing his facility size every month,
Right.
right? He was able to grow from $100,000 month one. Second month, he was already using over $10 million. A normal business will they'll fail because there's too little business or they'll fail because there's too much business, right?
Yeah.
In this case, he knew he had us to fund him, so he went on and took every bit of business he could get.
So it's a good problem.
Yeah, it was a great problem for him to
Yeah.
have, but it also allowed him to grow and really capture market share that nobody else could capture. He could continue to race as fast as he wanted to race and get all the business he wanted to get because he knew if he needed us, we were there for him, right? Because we were already prepared to fund him at least $10 million a month.
How do you know which is a good business to either acquire or fund?
Yeah. So in both cases, we're looking at the same set of docs. In the acquisition side of things, what we're looking at is, is their valuation that they're bringing to us, is that a good fit for the market, right? So prior to 2008, multipliers were 5 times revenue. We don't believe in EBITDA, by the way. So
Yeah, you don't like the DA part,
I
especially.
just don't like any of EBITDA, honestly, because it starts with earnings before, like,
Right.
well, all of that counts. So let's just leave it in there, right? Because you're not gonna not pay interest. You're not gonna
Right.
not pay taxes. Like, depreciation happens, amortization happens. Like, you can't avoid those
But the
things.
EBITDA is the standard thing that school teaches.
It does, but it's broken. because it's never just EBITDA. It's always adjusted EBITDA
Right.
or EBITDA plus a whole other alphabet of letters. That I mean, I've seen it. EBITDA plus XYZ,
I know.
POQ, right? Crazy. Right. So it's never the right way to do it. So, and here's the other thing. So let's say you're evaluating a business for an acquisition and they are using EBITDA. We're still going to look at their balance sheet and their income statement, and we're going to look and see what our calculation for that EBITDA number is. But we're looking at really net income over revenue. If net income over revenue, which is called net margin, is 25% or better,
Right.
we'll look at that deal, right? But when you're looking at EBITDA, how do you calculate that? You've got to decide what their numbers are and see if
Right.
your numbers match. And there's this whole going back and forth and
Yeah.
who's hiding what where kind of thing.
But what you're looking at is actually the fundamental how the business should work.
Yeah. And then we're looking at now, like in banking, they'll look at the last year's financials or the last year's balance sheet. Really,
Yeah.
they don't even look at the income statement in banking a lot of times. And so you're looking at 2024 balance sheet, and somehow you're able to decide if this business is good. You're missing 3/4 of the valuation, right? So with us, we're looking at balance sheet, income statement, accounts payable aging, and accounts receivable aging. But if you're a banker and all you're looking at is the balance sheet, you're blind.
Mm,
How you're
mm.
not even looking at what we're looking, right? So that's part of our evaluation. Before 2008, we would go out and hire a valuation company to evaluate the value of that business. But then 2008 happened, and it went from 5 times revenue to 2 times revenue, 1.5 times revenue, 1 times revenue, and now there's so many companies for sale. The supply is so high, the demand is so low, and by demand, I mean people with actual money to buy
Oh, yeah.
companies, that now valuations are down to where it's a multiplier of revenue of less than 1 times revenue. So
That's really little.
yeah, I'll give you an example. This is years ago, actually, after 2008, but since then, this guy came to us, $130 million value-added reseller of IT equipment to the US government. His per employee, revenue number was $2 million, okay? He was paying himself $2 million a month, which is fine. That's great for us, but his asking price was only $22 million. So 0.18, 0.19 times revenue, right? 20% of revenue. That's a multiplier of revenue. It's just a fraction.
Why is it so
So we didn't know. So when we looked at it, we were like, "That's a red flag. Something's wrong.
right?
Why would we wanna buy that?" But when we looked in it, everything was clean. There was nothing wrong. He had no kids to take the company over.
Oh,
His
okay.
wife had cancer, and he was 74, and he was like, "I'm done."
Oh, okay.
And so he all of a sudden decided he was for sale. And the problem is it came to us 2 things. It came to us through a broker. I think the business broker model is broken.
That's why they call
Broke
broker.
They are broker than they can believe, right? And it's like investment bankers. The typical broker goes out and spends all the money he thinks he's gonna get on commissions before he ever gets paid.
Mm,
And so they're always upside down, right? But anyway, so this guy brought us this deal. Turns out it was an auction. There were 20 other buyers, and I put those in air quotes because they didn't have money.
to
We
buy,
did,
yeah.
right? So when we looked at the deal, we said, "Look, first of all," we were on the phone with the seller. Like, he was super excited. We said, "First of all, we would have bought it at 50 million.
Mm,
But since you're asking 22 million,
why not?
yeah, it's a better deal for us. So, but either way, here's our down payment. We're gonna do a down payment earnout, and our down payment is 10.6 million.
Yeah.
So based on that down payment and the fact that we're not gonna take a $2 million salary or owner compensation, we can turn that into paying you off. We'll pay off the seller finance in 6 to 9 months. So you won't be out for long. It's just it makes our deal look better if we structure it that way.
Mhm.
We're not upside down. So most buyers of companies go in with SBA.
Yeah.
I would avoid that with like the plague. I love people in SBA. I've got friends who are in SBA. I work with people in SBA, but buying a company with an SBA loan in this market does not make sense because what you're doing is you're saying, okay, it's 22 million. I'll give you 22 million cash because the SBA loan is going to be that 22 million. But what did you do? You got equity to get that. So you had to go raise 10% or 5% or whatever that equity was that SBA requires.
Yeah.
So there's a raise involved, right? So you're raising equity. That's not a one call equity call. That's multiple presentations, dog and
Right.
pony show, the same thing that everybody else is going through in VC and angel and PE and even investment banker world. It's an equity raise. And then on top of that, you're gonna lock up all the assets of the business, and then you're gonna have covenants, and those the loan can only do what the loan can do. And so if there's concentration issues, that gets taken out. If there's industry issues, that gets taken out. So the loan amount is limited based on lending practices, right?
Okay.
Because it's not the SBA loaning you money. The SBA is just guaranteeing the loan, right? So these guys who do this, and I've had friends who did it, and they went, and bought 2 companies for multiple millions of dollars with an SBA loan. And when they did that, they they came and called me back and said I shouldn't have done that. It was the worst. And I recently had a guy call me and tell me the same thing. He said, I've been working on this deal for over a year. The SBA still hasn't approved it, and I've locked the seller up for a year.
And I think SBA just, by the time we're talking, just make the whole thing even more strict.
Oh, yeah. That's gonna be worse. It's gonna
Yeah.
be way worse.
I think it happened
That's
like a
the other
week ago.
that's the other thing. The SBA changes their underwear all the time. Like, they're constantly changing their mind. Like, couldn't you just let this be for a little bit, right? But the biggest problem, though, with an SBA loan is you spent $22 million at the closing table, and day 1, you don't know how you're gonna make payroll on Friday
Right.
because you just spent it all. You got nothing, right? So the the model is broken, and you're not even bankable. The day 1 after you've acquired a business like that, no bank wants you at all. They want you to go away. You've got no retained earnings. It's a brand new company because even though it's an acquisition, none of that history transfers. You're new to the bank. So you're a brand new company. It's just
Right.
like a movie, startup film and a script in a LLC. There's nothing there but the script. There's
Yeah.
nothing to buy, right?
Right.
The banks don't wanna lend against that. They want history, right? And so the way we do it, we come to that acquisition, we're buying at a down payment and earn-out. So day 1, we already know where our funds are coming for, payroll on Friday, because we're that funding. We've already approved that. We approve $500,000, for month 1. That's times 12. That's $6 million is what we've approved for the year, right? So we know where that's coming every single month. We know where it's coming, right? And then um, we don't have to worry about making payroll, paying taxes, paying vendors, making AP pays. All of that's done, right? We're bankable because a bank will look at us and go, okay, even though the entity's new, we see how you're set up, and we can see how you can pay your payables. And so there's not much you can do, but here's what we can do. Like, we're already bankable, right? So it sets the buyer up into a position that protects the seller because now he's getting paid out over time by that buyer, right? Whereas an SBA, yeah, maybe the seller got 100% at the closing table, but because it was an SBA loan, they talked him down 5, 10, 15, 20% off his original asking price. We're not doing that. We're already looking at centuries low numbers in acquisition prices. The prices are good. If I can make that work, then let me do a down payment and earn out, and you'll have your money over time, which, by the way, which would you rather pay capital gains on? 20% down and a portion every year, which you can decide how much that portion is every year and decide whether you wanna pay taxes on or not? Or would you like to pay, uh, a tax bill on 100% of the asking price? Which, by the way, the US government, they deserve it, it's the rules, but that's gonna be half of the money that
Right,
you're getting
exactly.
at the closing
See,
table.
a lot of people doing investment or business, they just don't really think about the tax part. The
Yeah.
tax part is one of the most expensive thing that you can ever pay in your whole life.
Yeah. So, I stopped convincing, business owners to keep
Right.
their business and use us for funding because they were gonna sell anyway. So I started convincing them, "Look, you can mitigate this tax liability if you do this right. You know,
Right.
I'm not an advisor, but there's ways around this so
Right.
you don't have to pay all that money out.
Right. And also with the multiplier, why do you think, oh, I mean, different industries have different multipliers and within the industry has different multipliers, but how do you know what is a good multiplier for certain businesses?
So we're not doing the valuation.
Okay.
So they're coming to us with the valuation, and I have a
Then
rule of
how do
thumb.
you, yeah, but how do you know it's correct? How
So
do you know
I have a
it's,
rule of thumb. As long as it's lower than one times revenue, I'll look at it, right?
oh, okay.
If it's one times revenue or higher, I'm gonna start saying, "Well, maybe we need to take a look at this."
Okay.
But I'll still look at the deal if we can make it work. I mean, I'm taking him out over time anyway, so there's a little bit of give and take on both sides of it. I'm not asking people to come to me with a higher number, but the market is like the way it is right now, so it's going to come to me low. I don't need to go out and do that.
Right.
I also know how to value companies. There's 14 plus different ways to value a company.
You told me
So
16, so
oh, 16, yeah, 14 plus, 16,
14 plus. Okay.
yeah.
Fair enough.
So, depending on my, my patience in a day. But industries and verticals and, th across most of them, like, manufacturing is the same in oil field as it is in, manufacturing consumer goods. The valuation is gonna still be the same, right? It's just a different industry that it's manufacturing in. Profitability, was gonna drive that more than the industry. Like, for instance, in certain industries, where big electric vehicle companies or big space development companies that I can't name are involved. The profitability might be lower because they're really good at pressing the margin, right? Same thing with home product companies, that sell nails and hammers and lights and fans and stuff like that. They're pressing those margins hard. They're not getting much, and they're not going to give up much either. So, those kinda doing business with those kind of companies is fine, but you also wanna have more profitable customers. So if you can make the same product for oil field where, they needed it yesterday, they're losing $1,000,000 a day,
I did it
and you can
yesterday.
deliver the same product to them,
Right.
at a 30% markup, you know? Why would you sell it to, you know, a lumber company, I don't wanna
Right.
say the name of these companies, but a lumber company at a 5% markup? Like, yeah, it's great that that's a name that everybody recognizes, but who
But
cares?
yeah, yeah.
I'll give you an interesting idea. So this one company came to us, it was through, um, a board member of a bank, and he was invested in the deal. He was really pressuring us to do this deal, and they were doing $30,000,000 a year in revenue. They were out of Mexico, but they had presence here in America, so we were open to taking a look at it. But I told him how inexpensive it was a funding deal. I told him how inexpensive our funds were, and he said, "Oh, that won't work." And I'm like, "What? Wait a second. Hold on. I didn't ask a question. What is your
How
profit margin and what is your net margin?" And he said, "Well, my gross margin is 4.76%.
that's like this.
Yeah, and my net is
That's
2.77."
like
Like,
this.
I said, "Wait a second.
A
So if you
sneeze.
sneeze, this is gone. Like, you're right. This doesn't work for you. I'm
Yeah.
sorry."
Oh my god.
I don't understand that. And people were investing as equity investors in it. So that
Yeah.
means the cost of money was much higher.
Yeah. Oh yeah.
Like, so even less room to wiggle.
I got this comment all the time. It's like,
Mm,
why do you want to go into the technically primary market
mhm.
when you can go to stock market and all the financials are clear? I was like, that's not exactly true because you're looking at every
Quarter,
season.
yeah.
So, but that number you can only see, the business goes every day, but you're only looking at every 100 days.
Sure, that's true. Yeah. Yeah, so it's definitely there's definitely a challenge in the public markets. I invest, small dollars in the public market
And
no
that's your
matter what.
gambling money,
It's
dog food money.
I still don't know what I'm doing, honestly. I really rather track the S&P 500 than anything, but, and that's what Warren Buffett says to do, so he's smart. I'll do what he says, but I play around with it, like here and there. I'll get a stock just to see what's happening. Some of them I've had, 1,000% return on, but I didn't have a lot of money in it, so it doesn't matter. But
Last time you showed me you have something like $90
yeah,
for
yeah,
a stock.
well, some of them, yeah. Those are small examples, but yeah, I mean, it's not like I'm very interested in that.
Yeah.
I wanted to be able to speak intelligently when somebody tried to talk to me about a public stock, and so
Right.
I said, "What would be a good stock to be in?" Right? And it's interesting because I got into a stock that's in the uranium industry,
Oh,
and didn't think at first that I'd wanna do it, but when I started evaluating the financials, it seemed to make a lot of sense, and that's
right.
one of the ones that I've had a huge percentage
Yeah.
increase on, not dollars, but
And also, for evaluation purposes, like for you, you look at almost like daily cash flow.
yeah, in
But
our business, yeah.
right, but it's supposed to be that way because that's how business runs every day. It's not like business run on Monday, not on Friday.
Yeah, but you look at VC or LPs in private equity, and they're throwing money and turn around and forgetting. They don't follow it on it.
But they do numbers game. They hope 1 out of 10 that
Yeah.
actually
I
works.
don't bet like that. My bets are everything wins or I'm not in. Like,
Right.
that's
But like,
it.
how do you? Let's say I don't know how do. I don't know if you can tell me the number. How many companies do you actually either fund or own acquired under your company?
On the acquisition side, we're really not, allowed to talk about it. We have, over 10 holding companies.
Oh, holding
Yeah,
companies.
but
Okay.
that's not acquisitions at all, and, I mean, it's not as much as I'd like to see. I don't know, we've had some really bad years recently, and we've had to turn down, and, it sounds like I'm complaining, but I'm glad because later on, we found out some of those companies went under. They sold, but the guy who bought it drove it in the ground or whatever.
Okay.
Or the guy who bought it's coming back to me going, "How do I fix this?" Like, "I don't know. Why you buy
So
it?"
when you acquire those companies, especially for acquisition, how long do you hold it?
Oh, we're not buying for short term. We don't buy and flip. It goes back to the tax liability. Like, why would you trade a, you know, goose that lays a golden egg, a cash machine that's putting out, let's say, 25, 35,
Right.
40% every month? Why would you trade that in for a one-time tax bill, a half of your valuation? Even if it is 4 times, what you put into it, still, you're gonna get half of that. It's only 2 times, like, so if you just hold it for 4 more years, you're already doing better. Look, so there's plenty of, guys who got rich by investing in Bitcoin or who, got, rich investing in flipping houses and stuff like that. I'm not saying that you can't do that, but when you really look at, like, generational wealth and, families that are set for forever, you're looking at, Rockefeller.
Acquisition.
Well, you're looking at Rockefeller,
Right.
you're looking at the Kennedys, like, in the '20s when the market crashed, the Kennedys had, I think it was a $4 million net worth. Back then, it was a lot of money, right?
Right.
Now it's not so much.
Talking about
But
inflation.
but they looked at what was happening, and they had cousins who were in the, Congress, and they were like, "Oh, crap. These guys are gonna come after our money. That's what's gonna happen." Well, and how do they do that? They raise income taxes, right?
Right.
So before their cousins could raise income taxes, they invested all their net worth in businesses who were going through a crisis. All the valuations were low because the whole country was in a depression, right? So they could buy companies at pennies on the dollar. Sometimes they were buying them for 3, 4 cents on a dollar, right? And so then, sure enough, 8 years into the depression, the Kennedy's cousins were raising taxes, and income taxes got to 90% income,
Oh, right. I know that part.
right?
Yeah.
So what happened to the Kennedys? Well, the Kennedys' cousins came to go get the money from the Kennedys, and the Kennedys pulled their pockets out and said, "We don't
We
got
don't have
any
money.
money.
Yeah.
We just bought all these businesses and kept
Right.
all these people employed. You wanna
I
fire 'em?
know.
You go ahead and fire them."
And then there's the interesting thing. The most wealthy people don't have money. They have assets.
Everybody I know who's ever won the lottery is broke.
Right.
Everybody I know who's ever hit it big on one thing spent all their money and they're broke.
Yeah.
Everybody I know who's had a hit TV show or a hit movie, at one point they lost all that money and they're broke again, and they're
Right.
coming out for another way to get rich, right?
Right, because they're focused
They didn't buy
on
assets.
right, because they're focusing on the money, and they're not focusing. I remember Robert Kiyosaki was saying that I don't own anything. Like I don't own anything. That way, nobody can take away stuff from me.
Yeah. So
But
you put it in limited liability
yeah,
corporations, or you put it in trusts. You put it in places where you don't own it, but you
but
can get paid by it, right?
right,
Yeah.
that's called asset protection.
Yeah, and that's a whole other thing. I'm not a lawyer at
Yeah.
all, but I'm learning that there's ways to set up vehicles where the vehicle gets the equity in the business, and
Right,
then
exactly.
the revenue off of that equity comes into the vehicle, and then the vehicle has a master service organization arrangement with a non-revocable contract. I'm not advising anybody on this, but this is what I'm learning. That they can get a non-revocable contract for 90% of that income coming
Right,
into that MSO,
but technically they don't own it.
and they're getting paid off of all of that. So there's no way somebody can come in and take it from them.
Because technically, if you actually own stuff under your name, you're like one sneeze away. If something goes wrong, one
Mhm.
sneeze away
Sure.
from wiped out.
Yeah, for sure.
You have all kinds of business under your portfolio, but how do you balance it? Like, there's no way that you gotta have like concentration is bad for a portfolio,
Mhm.
but how do you think about that?
We look at it. We have one really big on the funding side of things. We have one really big customer right now. We just go and get more customers, and then eventually that becomes a smaller percentage of the funding portfolio. Um, Acquisitions, like I'm looking at an acquisition right now that's a $300 million oil field services company, and it makes me a little nervous because that would be a very large portion of our total acquisitions. So I'm being extra careful, right? I want to make sure every I is dotted, every T is crossed. And to be honest, I don't hold out a lot of hope in those deals, because a guy who's got a $300 million oil field services company and he's selling it is probably going to sell to a strategic buyer.
Right.
And I mean, let's be honest, he's clearing $20 million a month. Again, why should he sell that, right? What's the motivation? Because he sells that. What's 50% of 300 million that he's got to now have to pay to the U.S. government, right? Why put himself through that? So it makes the deal so much harder to do, right? It's got to be a good deal for him. It's got to be a good deal for us, right? We can't go into a deal paying a premium when everything else is not a premium, right?
Talking about the CEO thing, we were just talking about that at the at late lunch. Maybe it's a late lunch.
Yeah,
So how the business structure a deal is very important, because a lot of people think CEO is actually the uh,
owner.
owner, but that's just not entirely true. It's really a matter about how the company is structured.
Yeah,
CEO is just a lot of times just an employee.
yeah. I mean, I don't know why, but the popular culture has decided to lift up the chief executive officer and
Like an
president
owner.
of a company to some level where he's an owner. And in some cases they are small owners. But we were looking at funding a solar company a couple years ago, and the CEO was sitting across from me, and he's the CEO's, and I'm sitting in his doghouse, so he's acting a little cocky. And I said, "Well, tell me, how much of the company you own, because I realized CEOs don't always own the company, right?" And that's when he got serious. He said, "Well,
Mm,
I only own 5% of the company." And I said, "Well, then I'm gonna advise you not to sign up for our funding right now, because you don't have enough skin in the game,
yeah,
and you're gonna be the one that signs this. And if you sign this and it goes wrong, you're gonna get held responsible, even though
right,
you're only 5% of the ownership of this company. What you need to do, if you really wanna do this and you want us to fund you, is you need to go to your board and get a board memorandum that says
right,
you're authorized to sign on their behalf. It's gonna have to obligate them, though, because otherwise we'll still come back to you."
right.
And as an employee of the company, I don't recommend you doing that.
Right, as an employee of a company. It's really hard for people to believe a lot of founders or CEOs don't get anything when the company got sold.
I've seen so many deals where it wasn't even before they got sold. They were going through investment rounds. They founded the company. They got to
Sure, getting smaller and smaller.
yeah, they got to a place where they needed to sell more equity. So what happens? They got to a place where they were somewhere in the neighborhood of 8 to 12% is the annual or the average number for people who are raising money that way. And it's just normal. So everybody just does it, and they don't think about it, right? I had a guy come to me one day, and he just to give it a story, he was pitching me on a cryptocurrency based on fitness and how it was.
Pitch you about the crypto thing.
Yeah, he wanted me to invest in his business so he could have this cryptocurrency fitness reward system and
Okay.
how it was gonna make a $1 billion company in 5 years, right? And I could tell he was talking to me, and I was like one of the first people he was raising money from, and he wanted me to write a $50,000 check.
That's
And
a small check.
well, but if you think about it, he was fresh off the boat from Egypt. He figured out how to do what people in Y Combinator were doing, and so he was doing the same thing. He'd come up with this idea, and he wanted me to invest $50,000 into his, pre-seed round of this business. And I said, "Well, I get why you're asking for 50,000 because that's probably what you make in a year right now, and that's what's going to keep you going, so you can go do this full time, so you can go raise a whole whole lot of money, right?" I said, "But do me a favor. How much?" And he had already shared this in the presentation, but I went back on it. I said, "How much of the company will you own in 5 years?" He said, 8 to 12%. I said, "So you're gonna not own a whole lot of this business. What's the benefit in you doing this?" And he said, "Well, I'll be the CEO of this business." I said, "Let me give you some perspective, right?" So I told him about this value-added reseller of IT equipment that I was telling you about that put $130 million in revenue. The asking price was $22 million, so it was 0.18, 0.19 times revenue. $2 million in monthly owner compensation to the owner, and I dropped the mic. I said, "How much are you gonna make as the CEO of this business?" "I'm gonna be the CEO of a billion-dollar company in 5 years." "How much you gonna make on a monthly basis?"
Right.
He had no clue. So I said, "Let's Google it." So we Googled it, and Google said somewhere between $350,000 and $500,000 a year in income as the CEO
Yeah.
with 8% ownership of the business. I said, how are you gonna feed your family, dude?"
Yeah.
I mean, I get it's more than what you're making right now, but when you get there, it's not gonna
Oh,
be
yeah.
enough.
Yeah.
That's not okay, right? So why would I invest in that? What is the value in me investing that? He was mad at me, so I was like, "Well, I can't help you,
Yeah.
Sorry about that."
I remember you told me this story about Warren Buffett and Disney. I think it's very
Mhm,
interesting.
mhm.
So Warren Buffett got Disney not from the public market, if I'm
Mm-mm.
right,
Right,
right?
yeah, right. Yeah, this is what most people don't understand. He does buy stocks on the public market. He's got a brokerage account, and he Berkshire Hathaway moves money in and out of the public markets all the time. But his acquisition of Disney shares was when they were in a really bad place,
When
and
was that?
I can't remember what year it was.
Like this
We can look
century
it
or
up.
last century?
This century or last. It was in the 90s, right?
Oh, okay.
Late 90s, I think.
Mm.
Maybe it was early 2000s, somewhere around there.
Yeah.
But anyways, they really needed money. So he negotiated a super low deal on their equity. Like their stock was trading at, let's say 100. He was getting
Yeah.
it for 40,
Right.
right? And he had options when he sold to sell it for a lot more than it was worth. So he didn't buy it like a normal stock
Yeah.
owner. He bought it like a business owner. Like he saw the value that it could be if
Right,
he was
exactly.
the financing, 'cause they couldn't get financing from anybody else. They were in trouble. They were having to pay back loans. They were, getting defaulted on loans. They were in trouble, right? And he was gonna save them. So he said, "If I'm gonna save you, I want a reward for that risk." And when he sold his Disney shares, he sold at a above market price that nobody could get because he had a private deal
Right.
on the side.
This is the thing people don't
Oh,
understand. Like even this company is on the secondary market, the public market. You can still make a deal in the private.
Yep.
But the private market exists way before the public market even exists.
Yeah. Most founders are as they're building businesses, they will create common stock and preferred stock.
Right.
So there's already two different parts of the business anyway, right?
Yeah.
And they always share or save shares that they can sell later. So even when you're looking at Tesla or SpaceX or Amazon, there's a bunch of shares that haven't been sold that they
Yeah.
could sell at any time, and they don't have to sell them on the public market.
Right, exactly.
They can negotiate private deals, and they do it all the time.
This is the information gap between
Yeah.
average Joe and just whoever that work in this field, like kind of you and me.
Yeah.
But this is something I think SEC or in another way, like the private market has been very hidden from the public market.
Sure.
It is
The only people who know what's going on in the private market are in Congress, and they're doing insider trading.
well, it's hard. I always tell people it's really hard for those people not doing insider trading. When you get to that position,
Sure.
you
Yeah.
just have information.
Right. But they're also getting better deals too.
Of course,
They're
because
not just buying strictly off the market either.
yeah, because who they are. What is
Yeah.
Nancy Pelosi's Congress Warren Buffett?
Yeah, I wouldn't call her Warren Buffett at all. She didn't get lucky. She got advantages that people just don't have.
Yeah, but I think the information gap between the private and public market is huge. And
Oh, yeah,
then
sure.
for whatever reason, is it good reason or bad reason or legal reason, this what is it? This wall just hasn't been taken down.
Well, you're never going to get privately owned companies to give up their financials.
course.
There are a lot of systems that have tried to do this. LexisNexis and some other companies like that have tried to pay bankers
Right.
to leak private information anonymously
Anonymously.
so that they could have a pool of anonymous information so that LexisNexis could infer things that were happening in the private market that they
Right.
can't see like they can in the public market, but it never works out. No private business owner is going to say, "Sure, look under my skirt. Like, look
Oh,
at
no.
me. Let me take my kimono off so you can see this, right? Here's my wart over here, right?" They're not going to do that if they don't have to, especially if you're
Right.
not involved in their business at all. If you're a
Right.
lender, they have to. They have to take
Yeah.
the kimono off. But if they don't need lending, they don't need to show you that information. There's no
Right.
reason why. And most of the private companies, by the way, most of the private companies in America are not even operating companies.
Mm.
Most of the companies in America, private held companies in America, are foundations, trusts, and holding companies
Right.
that have nothing to do with operations. So no way in a snowball's chance in hell are you going to get that information. That's not your information to have.
So how people get this kind of information is you have to be in this field for a good
Be in
reason.
that circle.
Right.
you
So
know?
networking, we'll go back to networking.
Mhm.
So networking is really important. Like who you know is gonna give you a lot of advantage.
I met a billionaire.
You mean not yourself?
I'm not. I'm going to be there soon, but I'm not. But
There's something that I can even
I met I met a billionaire in the restroom in Dallas one time.
in the restroom.
Yeah,
Nice place.
peeing right next to each other. It was great. And I introduced myself, which is not etiquette, but I did it anyway. And I found out he owned 350 plus companies,
Oh.
and he had a lot of assets, like we were talking about earlier. And he invited me up to his house after we talked about a bunch of things. At the time, I say I owned 9 businesses, but really what was happening is those
9
businesses
holding.
owned me.
Oh, okay.
I was not working. Every minute of every day was spent working in those 9 businesses, right? So for me, ownership was a totally different thing. And so when I went to visit him 2 weeks later, he had sold all but 5. He kept 5 of his best businesses and sold all the other businesses and reinvested into those and did some
Okay.
things with trusts and stuff like that. And I was like, wow, how do you run 350 businesses? And he looked at me like I had lost my head. He looked like I had 3 eyeballs or something like that. He's like, Eric,
Why do you have to run that?
I don't I don't run them. I own
Yeah,
them.
yeah,
Like,
yeah.
what are you asking? Like,
Yeah.
it was a totally different question to him. And at that time, my brain exploded. Like, wait a second, what am I doing? Like, I'm
That must
running
be like
the
20 years ago or something.
no, it wasn't that long ago, was it? Maybe so. Holy cow. Wow. Anyway, so needless to say, I learned a lot from that gentleman, just in what you can do. And for me, life in general, but especially in the business world, is like playing one of those multiplayer, online games,
Right.
MMOGs, right? And you go into the field and you kill a couple of monsters, you get some experience points and some money, and you go into the store and you buy some more armor and you upgrade, and then you eventually get to the end of the first level and you beat the boss. And that's the first time you get to poke up into the second level and go, oh, look what's up here, right?
Yeah.
And it's a totally different world, right? That's the same thing that happened, for Elon Musk when he started seeing, so he started popping up in new levels, right? That's what happened to me when I met this billionaire. I was down here and way low, and he showed me what was happening at his billionaire level. And I'm like, holy crap, there are a bunch of levels between me and you.
Yeah.
And he gave me a view of what was happening for his world, and it made me realize I didn't know anything.
And then a lot of people think you own like $5 million revenue business. It's basically you acquire that business, you acquire a job.
If the business owner hasn't set it up correctly, then they're wearing all the hats. They're making all the decisions. All of the clients are there because of them, and there's no way to sell that business because the next buyer has to do the exact same thing that the seller was doing. And it's why sellers don't understand why people want to buy their business, because why would you want to have all this stress, right? I was talking to a guy just the other day about this, and he was I'm selling because I want to get out of this and get into real estate because I want less stress in my life. Why would you want to buy my business? And I honestly, I don't know if I want to buy his business because he's every single decision, right? And yeah, and so unless he's got a CFO, a CIO, a COO, a CEO running his business for him, then I don't want his business. I don't, because it won't survive him leaving, right? So we call that goodwill, right? If all the goodwill is wrapped up in the CEO or the owner of the company, in this case, then that business won't survive with that owner gone. It needs to have the right people in the right seats in the bus.
Yeah, any other stories you want to add? Until the lights just starting.
All right. Well, we've gotten into other things like film and TV and music production.
And that's how we know each other.
Yeah, well,
Strangely.
yeah, right. That. Although I recently did a TV show. It's called The Promised Land. It's if you go to thepromisedlandseries.tv, you can see the first episode for free. I'm actually in it. If you go in the middle, have you seen my TV show yet?
I'm gonna cut this part out. I follow that on the Instagram, by the way.
But you haven't watched the show yet.
I watched a short. I didn't watch the whole show.
You need to watch the
Okay.
in the middle of the episode. I'm in there. Okay.
Oh, in the middle of which is the first season, right?
No, first episode. The season's not out yet.
Oh,
so
okay.
This is the first episode. The pilot is out, and it's a 33-minute pilot, so it's not that long. And it's like The Office or
that.
Parks and Recreation. It's funny, right? Okay. And in the middle of it, I'm in the tent. I'm standing on one side of a guy, another guy's standing on the other side of the guy, and we're arguing about why he stole my goat.
Oh, okay.
Hilarious.
Okay, I'll take a look. Food smells so good.
Oh, I know, right?
Anyway, I think that's about it. It smells so good. I need to get some more cookie.
Yep.
Okay, let's go
Time
to
for cookies.
Yeah, I know. Time for cookie.